Dear viewers, welcome to our channel GVS Bank Academy. Now I am going to discuss about JAIIB, Accounting and Financial Management for Bankers, memory based record questions from exam dated 14/5/2023, part 2. First part is already uploaded, second part 16 to 23 questions. For the October and JAIIB exams, November and December CAIIB exams our classes are in progress. Interested members are requested to contact on this number. Question number 16, already question up to 15 was uploaded. Now question number 16, net worth of the company or net worth. Capital, paid up capital plus reserves plus surplus if any. This is the net worth. And tangible net worth is equal to net worth minus intangible assets. Net worth, capital, reserves, surplus. Tangible net worth is equal to net worth minus intangible assets. Then question number 17, statutory audit of bank branches. As per Banking Regulation Act 1949, annual financial statements in the form of P&L and balance sheet are required to be audited in accordance with the applicable statutes. Statutory audit appointed by the chartered accountant mainly looks at the loans and advances part, compliance with priority sector lending, cash reserve ratio compliance, statutory liquidity ratio compliance, CRAR, capital to risk weighted assets ratio compliance, and other statutory norms compliance as per RBI guidelines, master directions and master circulars. And after completion of the audit, he will give long form audit report, LFAR, long form audit report, very important. He will submit his report in the form of LFAR, long form audit report, and tax audit report. LFAR report also signed by the statutory auditor, and tax audit forms are also submitted by statutory. This is mandatory. Now question number 18, as per section 2 subsection 31 of Income Tax Act, person includes the following. As for income tax, who is a person? Individual, HUF, company, firm, association of persons or body of individuals, whether incorporated means registered or not, a local authority, local government, every artificial judicial person not falling within any of the preceding category, any artificial person not falling within the above category. So these are the person includes individual, HUF, company, firm, association of persons, body of individuals, whether incorporated or not. This is about question number 18, person defines under section 2 subsection 31. Difficulty level question. This is a very difficulty level. Question number 19, there are 4-5 questions are there. All 4-5 I am discussing in one question. That is question number 19, derivatives. Derivatives are risk management tools. Risk management tools. OTC, not a OTC means exchange traded derivatives. Futures and options are exchange traded. OTC, over the counter, non-exchange traded derivatives are forward exchange contract, swaps, forward rate agreement. What is the definition of derivative? Derivative value derived from underlying asset or set of assets. The earlier derivative depends upon underlying assets. Settlement at a future date. Any derivative, the main objective settlement at a future date, but pre-agreed future date. And for entering into derivative transactions, initial investment is negligible, that is there. Then again, these two questions also they are asked. Forward exchange contract or forward contract. An agreement between two over the counter, two eligible parties to exchange currencies at a future date, forward rate, traded over the counter. And not exchange traded, non-exchange traded forward contract. So everything futures are there, but it is non-exchange. Future contract, it is also an agreement to buy a product, to sell an asset for a certain price at a certain future date. This is also a forward contract, but traded on stock exchanges. Traded on stock exchange. What is the main difference between forwards and futures? Forwards are non-exchange traded, futures are exchange traded. So, on the basis of this, we can discuss 2-3 differences. Forward exchange contract, any amount we can write the forward. Future contract only stock exchange prescribed norms. And initial margin is not required for entering into foreign exchange contract. Future contract initial margin is required. Forward exchange contract, liquidity is less. Future contract, liquidity is more since it is traded in the stock exchange. Forward contract, default risk is more. Future contract, default risk is less because it is stock exchange traded. Stock exchange is collecting progressive margins also. So these are the 19 question derivatives. JAIIB first paper, economy, Indian economy, accountancy, principle of practice of banking and retail banking. And CAIIB also, almost in all papers, they are asking the questions about the derivatives. Very, very important topic for this. This question, a new type of question they had given this time. On 14/5/2023, they had given a different type of question. This is dividend. Normally, companies are distributing dividend part of the profit as to the shareholders. Part of the profit they are distributing in the form of dividends to shareholders, and part of the profit they are retaining as retained profit for future needs, future expansion and transferring to reserves also. So part of the profit is dividend, part of the profit is transferred to reserves for expansion. Now one more point, dividend is taxable in the hands of the shareholder. Whatever the company is paying on that dividend, the shareholder has to pay dividend distribution tax on the dividend. Companies also have to pay the dividend tax and individual also dividend also. Now, whatever the dividend is paying by the company, that is going to be debited to profit and loss appropriation account. Dividend paid is going to be debited profit and loss appropriation account. That is the dividend. And what is buyback? Both are a little bit related. Sometimes companies, instead of paying dividend, they are buybacking of its own shares from the market. Buyback of own shares by the company. Company decide to benefit the shareholder through buyback of shares instead of paying dividend. Instead of paying dividend to the shareholders, at market price of the share, the companies are buybacking the shares. What is the benefit to the company? And the floating shares, number of shares in the traded shares are going to be reduced to the extent of buyback, number one. Number two, the management of the company control is going to be taken by the management, number two. Number three, when number of shares, floating shares are coming down, normally EPS, earning per share, is going to be increased. After buyback, normally and generally, EPS of the company to the extent of buyback of shares, automatically EPS is going to be increased. Now, how the buyback of shares, where is the source of funds? Out of from the sources of free reserves. How the company can buy back free reserves? All companies, they are creating free reserves which can be utilized for buyback of shares. Securities premium account also buyback of shares. The proceeds of any other shares issued, other specified security. Proceeds of any other shares issued, other specified security. So they are dividend and buyback of shares. They are given a little bit difference is there. Dividend to the shareholders. Instead of paying dividend, they are buybacking of the shares. Some companies are doing buyback. This is about question number 20. Question number 21. 5-6 questions they had asked about deduction to be made in computing total income of the SSC. Deductions from the income. 4-5 questions they had given. I am discussing at a one point. Section 80C, various investments. 80CCC, insurance premium. And 80CCD1, National Pension Scheme, is maximum limited to deduction 1,50,000. 80C, 80CCC, 80CCD, new pension, National Pension Scheme 1,50,000. This is for all. And 80CCD 1B, additionally, National Pension Scheme, we can deposit 50,000, 1,50,000 plus new pension scheme, National Pension, 80CCD, we can get more, further another 50,000. This is 80CCD, National Pension Scheme, additionally. Section 80D, medical health insurance premium, normally 25,000 rupees we can deduct, age up to 60 years. 60 less than 60, per year we can deduct 25,000 towards payment of medical health insurance 80D. Senior citizens above 60 years, 50,000 rupees. And for parents, non-senior citizens are there, 25,000 additionally they will get. And for senior citizens, parents, 50,000 additionally they will get. This is about 80D. These questions, all questions they are asked. 80D, 80E, education loan. Whatever the interest paid by the borrower during that year, that entire amount is going to be deducted from the total income. 80E, deduction in respect of education loans. Section 80U, personal disability, 40% or more, but up to less than 80. And disability must be 40 or more, up to 80%. You will get a deduction 75,000. Where the disability is 80% or more, you will get 1,25,000. With severe disability, that is 80% or more disability, 1,25,000. 40 above and up to 80% disability, 75,000. That is section 80U. All the questions they are asked, accountancy on that day. Filing of income tax returns. Filing of income tax returns. E-filing of return is mandatory. What question they are written given? Where e-filing is not mandatory. That is the question. For all, e-filing is mandatory. However, paper returns can be filed by those who are above 80 years of age and do not have any income from regular business or profession. Those people who are not having any regular income from business or profession, they can also file paper return. Those people who are having age above 80 years, they are also allowed to file paper return. Otherwise, for remaining all the people, e-filing of return is mandatory. This question also they had asked. So, how many questions? Bunch of questions they had asked in this examination. This slide itself is very, very important for accountancy, and the same topic is there in Indian economy and also for retail banking. 3 papers. And golden rules of debit and credit in the accountancy. Golden rules of debit and credit. Type of accounts. Account to be debited, account to be credited. Simple. Personal account. Debit the receiver, credit the giver. Personal account. Debit the receiver, credit the giver. Real account. Debit what comes in and credit what goes out. Nominal account. Debit expenditure, expenses and losses, credit income and gains. Once again, personal account, all liabilities are personal accounts. What is the golden rule? Debit the receiver and credit the giver. All liabilities are always in credit balance. Real account, all assets are real account, all assets are always in debit balance. And golden rule, debit what comes in, what is coming in debit, what is going out credit. Nominal account, P&L, debit all expenditure and losses, we can debit to P&L. Expenditure and losses debit to P&L. And all income and gains created to P&L. Nominal account means P&L is a nominal account. This is the golden rule of debit and credit rule. This is 22. This question also 5 marks case study they had given. 5 marks case study 23 5 mark. Share capital can be classified into authorized capital, highest amount of the capital, nominal capital, registered capital. The company maximum can issue the shares to the public. This maximum. They cannot issue more than authorized capital. Normally this amount is mentioned in Memorandum of Association. Any company operating in India, they cannot issue capital more than what is the mentioned in authorized capital of the MOA. That is one. Out of this authorized capital, issued capital. From authorized capital, how much issued to public by the public company? Now normally only public company can issue shares to the public, and this amount is less than or equal to authorized capital. Normally issued capital is equal to authorized capital or less than authorized capital. That is there. It cannot be more than authorized capital. Subscribed capital. Out of issued capital, how much is subscribed by the public to the company? This subscribed. Subscribed capital always equal or less than subscribed capital. Subscribed capital is always less than issued capital or always equal to issued capital. Called up capital. Called up capital. The amount which the company has asked its shareholders to pay. After applying subscribed by the public, how much the company is requesting the shareholder for payment of on each share. On each share, how much the company is asking. So called up capital is equivalent to subscribed capital or less than subscribed capital. Last one is paid up capital. From the called up capital, how much actually paid to the company by the shareholder. Amount of capital which has actually paid by the shareholders, not more than called up capital. Not more than okay. So paid up capital, amount of capital which has actually paid by the shareholders out of called up capital. This cannot be more than called up capital. So this is about the authorized capital, highest amount of the capital. Paid up capital is the lowest amount of the capital. Company cannot go beyond the authorized capital. That is it. For all the purposes in the financial accounting, we are taking into consideration all the calculations. For all the calculations in the companies, for all accounts, we are taking paid up capital only into consideration. These are the 23 questions, up to 23 question discussion today. Thank you very much for friends for supporting our YouTube channel. For JAIIB, CAIIB online classes, interested members are requested to contact on the number. Thank you very much for all.